2022 Ways and Means meeting. Let's stand up and pledge the allegiance.
Does anyone have audio?
No,
There's no audio. Oh, can we unmute?
it says it's muted.
Where? This red button.
Oh, yeah.
No, there's this.
I unmuted.
You're good, thanks. Take two. Welcome to the January 5th, 2022 Ways and Means meeting. Please stand for the Pledge of Allegiance. I pledge
Allegiance to the flag
of the United States of America, and to the republic
and to the republic for which it stands, a nation, under God, indivisible, with liberty and justice for all.
Thank you, everyone. Sorry for the delay in getting started. There was just a couple of Wi-Fi issues to get resolved. Before we get started, I'd like to take a moment to welcome Ed Parsons and Chris Campbell to the Ways and Means Committee. They are replacing Kelly Pappas and Cody Case. Kelly has resigned and Cody has moved out of town, so they will be joining the Ways and Means going forward. And they are allocated to the school subcommittee, and they're going to make great additions to that committee. So welcome. Would you like to?
Welcome.
Would you like to give a quick introduction, Chris and Ed?
My wife and I and my daughter Kennedy, we live over on Donald Road. I'm politics and school administrator in Winchester, and so really looking forward to getting involved in Ways and Means.
I'm Ed Parsons. I'm a town meeting member from Precinct 6. I have two kids in the schools and happy to help out.
Welcome. So much.
So seeing no one on the line for public participation, we'll move into our first agenda item, and that would be the actuarial study of the other post-employment benefits that was completed for the year-ending calendar year, December 31st, 2021.
Thank you, Mr. Chair. This evening, we have from the Siegel Group, Kathleen Riley, who's the Senior Vice President in Actuarial, and Stephen Manning, who's an Associate Consultant. They've both been working on the, responsible for the reports that you have before you this evening, and they're both here to discuss and give a summary and answer questions. We'll all try to answer questions as raised.
Go. Thank you very much. So my name is Stephen Manning at Siegel. I'm here to go over the Town of Burlington Opeb report. And Opeb, as was said before, it stands for Other Post-Employment Benefits. And what we really mean by that is retiree health benefits. This is quite a large report. However, much of the information is actually sort of supplemental, and it just sort of goes into details on how the calculations were derived. So I'm just going to hit on a few pages that we feel sort of capture of what we need to get through in this report. But I'm happy to answer any questions either on what I go through or anything else in the report, at any time. So just before getting into this specific report and getting into the numbers, just want to take a quick step back and just go through what this report, is and sort of what it does. So this report calculates the benefit obligations for your retiree health costs. Then the second part of this report is that it outlines a plan to fund that obligation through a trust which currently has assets in it. So now we can get into the specific numbers for the town. If you would turn to page 12, this sort of covers most of the numbers that I'll go through this evening. Just looking at this page, there's two columns. The column on the left is the current valuation, so that's the year ending December 31st, 2020, and the one on the right, at least in the top section, is for the year ending December 31st, 2018. We do this report biannually. So just getting right into the numbers, as I said before, the purpose of this report is to calculate the benefit obligations for the retiree health benefits, and that really consists of two parts. First part are your current retirees, so these are the retirees that are currently on the retiree health plan and have the benefits, and they will be on the plan until they're off the plan, mortality or anything else. The second part is the current employees of the town. And what we're valuing here is when those retirees become, or when those active employees become retirees, the cost of their benefits throughout their lifetime, should they elect to have benefits, when they retire. So as you can see on line 3, the total obligations have increased from just under 106 million as of December 31st, 2018, up to just under 113 million as of December 31st, 2020. These obligations are expected to increase over time. If we looked at the report from last year, you'd see that these obligations were projected to increase. They have changed based off of a number of different data and assumptions, which I'll go through in a moment. Underneath that, you have the actuarial value of assets. So right now, you currently have some assets set aside to potentially, to eventually fund this obligation. The fifth line just shows the difference between the total benefit obligation, that sort of 113 million, and the actuarial value of the assets, which is 11.2 million as of December 31st, 2020. So that line number 5 is the unfunded liability that's increased from 98.5 million up to just under 102 million as of December 31st, 2020. And that's the liability that we're planning to fund with this report. So just as I mentioned, there was a lot of changes from the previous valuation to this valuation that sort of impacted the numbers. And as I said, we expected the unfunded liability to grow over these 2 years, and it actually did a little bit better than expected. Every 2 years, we get new participant data, sort of census data for each individual that's in the plan, and we run the liabilities on those participants, and then we also update assumptions sort of as appropriate. And all of the assumption changes are actually detailed on page 6 and 7 in this report. And again, I'm happy to answer any questions on any of the changes that we made to the assumptions. But I just wanted to touch on a few that sort of had large impacts on these numbers. The first assumption that sort of had a really big impact was we reset these baseline healthcare costs with each valuation. We get new claims information, new enrollment information from the town over the last 2 years, and we come up with a new, like I said, baseline healthcare costs, which are the foundation of the liabilities. And we had expected those costs to really go up over the 2-year period by about 13%, maybe a little bit more. While the costs did rise, they did not rise to the amount that we thought, that 13% trend. So that was an assumption that decreased the liabilities a little bit. We reset the trend assumption. Like I just said, the costs over the last few years have gone up a little bit, but we're actually expecting trends to get back to pre-pandemic levels going forward. With COVID, the claims cost had sort of stayed a little bit lower than anticipated. We're expecting everything to go back to the way it was sort of post-pandemic. So that was a trend reset. Second assumption that we reset was the participation election. So the actives can either elect to be a part of the retiree health benefits or not. Based on data we received, we actually increased the percentage of active members that would enroll in retiree health coverage. And the third one is the discount rate. As you'll see on the 2 columns, as of December 31st, 2018, the discount rate was 7.25%, and it's dropped to 7%. And this is just to bring the future obligations to the present, sort of a present value discount rate. On a macro level, we've seen that these discount rates have come down quite a bit with some of these big retiree health funds, so it was expected that discount rate would drop a little bit. So when you net out, like I said, the participant data change, those assumption changes that I talked about, and the additional assumption pages, the assumption changes on pages 6 and 7, we get unfunded liability increase from 98.5 to just under 102 million, like I stated. The next line I just want to touch on briefly is the funded ratio. So this is the ratio of the assets in the trust to the liabilities. You'll see that that increased from 2018. It was just a tiny bit above 7%, and now it's just basically at 10%. 2 points I want to make on this funded ratio. The first is that, we work on a lot of these funds for a lot of different municipalities, and a lot of these municipalities either have no assets at all or very little assets. So, good to see a decent funding ratio and some assets in the trust. And the second point, and it's really the more important point, is that there's a plan to pay off to fund this liability, not really pay it off, but to fund this liability, which we're just going to get into right now. So there are 2 ways to fund this liability, and the second one I'll get into on page 13. But the first way to pay it off is to set a fixed time period and then calculate payments to pay off, to fund the liability in that time period. The second way is to see what can be budgeted for this year and future years, and then see how long it'll take to get to fully funded. So again, you can either set the window and calculate the payments, or set the payments and then calculate the window. This section underneath where it says actuarially determined contribution for fiscal year ending, this is that first way. This is set the window and calculate the payments. This is something that we're required to calculate. It goes on financial statements and things like that. So I'm actually just going to skip down to line 9, and this would be sort of the payment that would need to be made in this current year if you were going to set the time period at the 25-year window that we sort of calculated for this report. This 9.2 really consists of 2 parts. Right above it, line 8, is the 6.3 million. That's an amortization payment, almost like a mortgage, paying off to get that liability funded. And above it is just a earned benefit on behalf of the active employee, which tends to grow over time. The one thing to note with this $9.2 million number is that it actually assumes that you're paying benefits out of the trust. So it needs to fund the trust by $9.2 million, and then the benefit payments would come out of it. That is not how the town is funding the benefits for retirees. Currently, the retiree health benefits are coming strictly out of the operating expenses, and the trust is just gaining assets through contributions and interest. So if you really were going to sort of net this out, that $5 million in benefit payments on line 10 would be netted out of that $9.2 million right above it in line 9, and it would be about a $4.2 million payment if the town was funding in this way. But how is the town actually funding? That is actually on page 13. So if you go to page 13, this is how the town is funding the obligation. And like I said, this is estimated payments and contributions that the town can make throughout the years, and then how long will it take to get to fully funding. There's a lot of numbers on here. It goes out a number of years down to 2048. Like I said, I can go through any and all of these numbers, but I'll just touch on a few just to sort of walk through this chart. So the first column I'd like to look at is column 4. It's called the projected benefits paid by the town. So this is really the basis of your liabilities. This is what needs to be paid for these retirees when they have their retiree health benefits. You can see that they grow each year. This is, trend increase. These are people coming in, people retiring and going into the plan. So you see, again, that grows over time. The next column I just wanted to touch on is the contributions to the Opeb trust. So this is really the plan. This is what, the estimate is to put into the fund each year in order to fund the obligations. The the increase each year, you know, these numbers, they increase by 9.3%. That's sort of the funding policy that's in place right now. I'll note in year one, the year one number is a little higher than year two, and that's due to the fact that it was a timing issue. Both payments were made sort of in the same time period, so that number looks a little off, but it's just, again, a matter of timing. So next to it is column 7, the assets at the end of the year. You see over time, these assets obviously grow. Nothing's being taken out of them. We're getting contributions into them, and it's growing with interest, that 7% that I talked about on the previous page. Column 8 is that total benefit obligation that I talked about before. Again, these obligations grow over time with trend and people coming into the plan. And then next to it is the unfunded piece. So you take the total obligations, subtract it by what you have in assets in order to pay those obligations, and that's your unfunded obligation. And you'll see that it's projected actually to rise over the first few years. And then once you get to, I think it's, 2031, you have a maximum unfunded of just under 125 million. And then after that, the assets grow at a faster rate than your total obligations grow, and then therefore that unfunded piece becomes less and less, and you can see that it eventually becomes zero. Next to it, and sort of lastly, is the funding percentage, which we talked about again on the previous page. We're just about 10% as of December 31st, 2020. You'll see that number sort of slowly creeps up. Again, the assets are growing a little slower than the total obligations are. But as you go down throughout the years, the funding percentage really picks up, and it eventually hits 100%, and the trust is fully funded after that period of time. I think that was all I had to go through on my list. I don't know if you had anything that you wanted to touch on, Kathy, before we open it up to questions or anything like that.
I think Stephen did a fine job. The one comment I guess I'd like to make, actuarial is a estimation based on data as received. The town has basically used a conservative approach in some of the estimations, and the Siegel Group has led us to those, having those discussions. Given some of the returns of the market as it stands right now, we're doing better from a valuation to this fund. So it's, I think the stewardship of the Siegel Group and the stewardship of the town leaders and this committee has helped develop a plan which is, I think, has been consistent and steady. And I think that it bodes well as we move forward.
So, Gary, if I could supplement what you said on page 13, those are projections of the actuarially determined contribution, and we probably should have sprinkled through our comments a little bit more often, assuming all assumptions are met, there are no changes in the plan of benefits, because they are projections, and we do expect they'll change. You know, we did compare them to what they looked at in the prior valuation, and they're very comparable. Full funding is within a year of what it was in the prior valuation. Prior valuation showed it on a fiscal year basis. This is a calendar year, so it's a little hard to compare. But, you know, I mean, when you're funding over that long a period of time, you certainly expect some variation, and there will be. But that's why you monitor it.
Yeah, this is why we take a look at it every 2 years and make sure we're still on course, and if
Right.
not, make adjustments so that way we can hit our goal.
Right, if you look at the actual valuation of our investments right now at the end of the calendar year, 2020 was $14,700,000, which is very good, but that's not.
2020 or 2021?
21.
21, okay.
So if you look at on page 13, it was estimated it would be 13,700,000. So
And it was
14.7.
Nice.
Yes.
Great.
As John would say, we've had a very good year. But again, you have to temper that. You're not going to have these gains in every single year. If you go back to 2020, when the market has had some strong adjustments since then, it's not something you continue to look at and think it's going to keep going every year. So it's better to temper it. and show better results than negative results.
Exactly.
So,
Okay, so I'll open it up to the floor for questions. If you're on the conference, feel free to raise your hand and I'll find you and ask. John, I'm sure you have questions.
Let them go first.
Okay, fair enough. Okay, Mike, go for it.
Oh, that was quick. I thought I'd be in line.
I thought you would be too, but I was trying to get John to stall for people to find the.
Put down those chips like.
Okay. It's kind of a simple question. So we're accumulating funds in the trust all the way out until 2047 or 2048, and we're not making any payments at that point out of the trust at all. Is that correct?
Yes.
And then once it's fully funded, what happens then?
Then the only contribution you need to make to the trust is to keep it fully funded, which is making that normal cost payment, the payment for current accruals, and that's column 1 on page 13, and in 2048, that's $7.3 million. But at that point, you start paying benefits out of the trust. So really, looking at, should have let Steve answer, I'm sorry. I didn't get enough to say yet.
Exactly.
So really, the way to look at it prior to that full funding date is your cost is what you're paying out of your operating cash, column 4, plus what's going into the trust, so column 4 plus 6. And in 2047, that totals about 24 million. And when you get to full funding, it drops to 7 million. And then you pay benefits out of the trust. So that's really where you see the savings, is when you look at the two pieces, what goes into the trust plus what you're no longer paying out of your operating budget.
Okay, so we have a big party in 2048 then.
Great. I won't be here, Steve.
Thank you.
I'll go with Phil.
Thank you, Mr. Chairman. On page 7, those red numbers are confusing me. The investment gain is $1,296,000, and the net decrease is $5,055,000. So I presume that that's a reduction in the overall actuarial liability, not a reduction in the amount of money that we have, right?
That would be correct, yeah, so that's the decrease in the liabilities, not the decrease in the.
So
in the
that's
trust.
good. So red is good in this case.
Correct, yep.
Thank you.
Yep.
On that page, Steve, Phil, you'll note that, and Stephen had talked about the lowering of the discount rate from 7.25 to 7. That affected this by $3.2 million, which was a negative number for us. Kept it up.
Right.
So
Thank you, Mr. Chairman.
I'd also like to know, Mr. Chairman, just for the people who know, our money is managed by PRIM, which is the Pension Reserve Investment Management Group, and they handle, I don't know how many retirement.
Oh, gee, on Opeb plans, I don't know.
Opeb
Probably,
plans, but-
probably 30 or 40, at least.
At least, and they are a very good group. They have quarterly reports. They're very solid. They don't look at, they're building portfolios based on actuarial returns and trying to minimize risk and costs. So they're tempered. You're not going to get the highest, you're not going to get the lowest, but you're going to get pretty well close to that high. And they're a good group. In the last year and a half, meeting with them on a quarterly basis virtually and listening to getting their information. They're very strong in what they do. They're very diversified in different markets and do a good job. So.
And they also manage the town's retirement funds as well.
Correct.
Frank?
Thank you, Mr. Chairman. Frank Monaco. The goal of this whole program is to accumulate enough money in an asset called a trust fund so that all retirement benefits that need to be paid on an annual basis can be paid from the earnings of the trust fund. Is that a correct statement, Stephen and Kathy?
No, Not necessarily from the earnings. I mean, the principal is available to pay benefits. If you were to, you know, this isn't going to happen, but if you were to shut off the plan when you get to full funding, you know, then you would have exactly, if all assumptions were met, exactly the right amount of money to pay out all the promised benefits. So it is possible, it's actually, when you get to the point of being fully funded there and you have to pay, you know, $20 million in benefit payments, and only $7 million is going in contributions, there could be years when you have to touch the principal. And there could, and, you know, there might be years when you have to touch the principal because your earnings don't meet the assumption, but on average, they.
You're free to do that, but unlike a retirement program, when I, as a retiree, and I'm living off of my, say, savings, 401s, trusts, equities, whatnot, when I die, it goes into my estate and it's over. This never dies, right? Assuming that you always have a town with employees with benefits for health care, this is perpetual. So you don't really want to, you can always spend some of the principal for bumps in the road, but at some point, it has to be a large enough trust fund that you still largely have no unfunded liabilities. That's the idea of this. Am I correct?
That is the idea. And to keep it that way, you know, again, if there are no fluctuations, you do need to keep putting normal cost payment for the additional benefits that are earned. And then you may or may not need to adjust for any fluctuations in liabilities or assets. And it could go either way. And that's where you start fine tuning it in those later years.
Right. So again, this is somewhat, I want to make sure I've got this right. I'm pretty sure I do, but it's for the benefit of people that might be listening. The whole goal here is to not have a liability of this magnitude that could potentially sack an operating budget or a community just because they can't pay for it and it's unfunded. So it would have to come right out of raise and appropriate, essentially. So by leaving this pile of money sitting there, you eliminate the risk, you eliminate the liability, and you can operate the benefit without fear of default or hurting your otherwise your operating plan of the community. The thing I don't like about this is, yeah, you can use some of the principle, and there's no laws that govern us on this. And I realize it's 25 years away, but it just feels a little strange that you'd operate it that way. I suspect what will happen at some point is you might want to leave some of the unfunded liability just because you figure you've got enough ability to cover things through, free cash and stabilization and whatnot. So I don't know what will happen when we get to the end. I think at this point, all we're really trying to do is get this trust fund large enough that the liability is close enough to zero, that it's not a risk to the town's operating budget and its revenues. That's really, in my mind, that's the goal. And the sooner we get there, the better off we are. And there's no laws that force us to go any faster. So we did this with, I think, the largest time frame that I think was allowed at the time, if I'm not mistaken, Kathy. You can't go any longer than this. I think it was a 30-year window was the maximum.
Well, you know, there really are no requirements to fund at all. There's no state requirement, there's no federal requirement, so this is really just being prudent for all the reasons you said. So 30 years was, is kind of is not an uncommon period to use when you're starting out initially from scratch on funding an obligation. And it fit well, I think, with what you could afford and that projected 9.3% increase. I agree with everything you said on sort of the goals of funding, and who knows what will happen as you get closer and closer to full funding. You are right for a municipality where you expect the population to be fairly constant. You would expect, you're always going to have employees, you're always going to have retirees. You probably are not going to be dipping into principal. It's always there to fund these liabilities that are sitting there. Now, if something happened and you shrunk your workforce you know, you might start dipping into principal as you had less normal cost coming in, sort of till things unwind. I guess the only piece that I would add to your comments are, you know, one of the reasons you fund is in addition for the benefit security for your employees and to stabilize your budget. There's also that sort of intergenerational equity. So you know, by funding people's normal cost while they're working, funding their benefits while they're working, you're paying for these benefits while you're getting a value for those employees. So, you know, that kind of always exists. It doesn't mean you have to adhere to it rigidly. So you might let someone funded liability hang around, or you might, you know, stick with the full funding objective. But, you know, as of now, there's no requirements to fund. It's a good idea for all the reasons you mentioned.
Okay, just my last comment, what you call the generational consideration. So the reason that all communities got into this situation, and Burlington is certainly one of them, is that we were not putting enough money aside to pay for the benefit in the future that had already been earned. That's what makes it an unfunded liability. And one of the things that we need to keep in mind here is that even though some people complain about, you know, why are we paying all this money for health insurance in the future? The truth of the matter is, those of us that have lived in the town for a considerable period of time got the benefit of all of those employees working for the town. And one of the assurances that we made to those employees was health care in their retirement, but we didn't pay into it. We didn't pay enough money, and that's why we have the liability. So, you know, if there's any complaint, it should be not paying this sooner, not that we're paying it now. We just don't want to that's why Ways and Means put this program forward, was to knock the liability down that had built up from, you know, a period of many, many years in the past by not funding it. And I think it's fair to do it that way. We just don't want to cripple the operating budget with annual OPEB installments. And that's why we picked the starting point in the 9% yearly escalation. It's just a gentle way to start to fill the hole and get done what we really owe. That would be the way I'd look at it. So thank you.
Thank you, Frank.
David?
Great, thanks. Just to piggyback on some of Frank's comments, again, when we put this plan in place, we kind of try to establish a number through the operating budget that we were comfortable in contributing, but not crippling ourselves. Now we've made, so you look at what's transpired over the last 2 years since our last actuarial study, and again, the number has gone up, but it was anticipated to go up. It didn't go up by as much, even though, again, we did some adjustments to it. So ultimately, the last 2 years, it's been a good thing. What's happened to this? We have made other contributions as we see fit over the last 5 years, with other certain items, certain free cash items where we have tried to get money into this trust, because the whole benefit is to try and get as much into the trust to maximize the earnings over the years, so that as you see each year, it's going up until that 2036, where it starts coming down. That's a matter of compounding interest on those earnings. So just to keep in mind as we get into budget season and all that, again, through the operating budget, we've established that 9.3%. Not bound by it, but it's a good thing to do. But just the more assets we can get into this, the more it's going to earn over time, and that compounding is only going to drive that number down more so in the future that we're able. So again, just something to think about. Nothing as that comment.
Thank you, Mr. Chairman. 2 questions.
Why this doesn't make any sense. If building up a fund is the object, and we are at historical low rates of interest for municipal borrowing, why doesn't it make sense for us to borrow $20 or $30 million at 3% and then get an average rate of return of 7% over the next 30 years from the S&P or the Dow Jones? Why doesn't that make sense?
So what you're referring to is.
Pre-fund it with 20 million bucks of borrowed money.
Yep, yep, there are reasons to consider that when the interest rates are right. And if interest rates were to stay low, that would certainly be a viable option. You know, there are, and as long as you earn in excess of the borrowing cost, it ends up being a good decision. And when you evaluate it, it's not just the interest rate, there are other expenses associated, but, you know, that's getting into the nitty-gritty. When you do it for a retirement system, they're referred to as pension obligation bonds. These would be Opeb, I guess, obligation bonds. You know, there are risks associated that your market timing could be off. You know, if you had invested this money in 2008, if you would have do this, you know, if you had done a transaction like this in 2008 and had a significant loss, you know, 2020, surprisingly, you know, we had a big loss and we came back. You know, the end of for a whole calendar year, we were okay. So
But we were 8,000 in 2008, and we're 36,000 13 years later. So we would be far ahead of the.
You know.
What could we borrow right now for 20 years? At 3.25%?
We could probably get it 3.25%. The community also has, you know, a 10-year program for capital improvements, and at some level, our rating, which is, you know, AAA and very strong, if we started to add a debt load.
But the bulk of the principal would still remain in the trust fund. But anyway, have you run those numbers with some scenarios of borrowing at 3 and getting a yield of 7 over 20 years?
We certainly could. I mean, I think that the risks are, you know, sort of the market timing issues.
Mm-hmm.
I will say, considering something like a $20 million bond is a lot less risky than fully funding it. And you're not suggesting that, but sometimes.
No, God, not $100 million, no.
Right. So, but if you were talking like a bond that fully funded the obligation, no matter the amount, that's a lot more risky than funding a piece of it. So that's actually, you know, it's a good consideration. The other drawback is you've replaced a flexible obligation with a fixed obligation, and then you have to weigh the risks of that, because this you don't have to fund. If you don't have the money to put this to put your $1 million or $1.5 million in, you don't have to make the payment.
That's what got us in trouble in the first place.
No,
is
I know.
We didn't pay our obligation.
I know.
This would fix it for the time period, and I think it would reduce the overall retirement number from 47 down to probably 37.
You would save, you know, again, assuming you made the 3% return, or whatever the cost of the bond.
Cost of funds.
Yeah, and so, you know, usually when you do something like that, you run it at, you know, you say, okay, we'll invest it, we'll get our 7%, and you see how it lowers your numbers. And you might not come down that far if you don't achieve the 7%, but as long as you achieve the borrowing cost,
You'd be
it's always,
fine.
it's a good deal.
Thank you. Would it be possible to run that scenario?
Paul Sagarino sent an email last week to me and to John Denizio to possibly start looking at such a scenario. So we're doing that along with, as we start this budget cycle, along with the capital needs that are forthcoming. And we're also looking at the possible opportunity of making an additional contribution above what has been suggested this year. So we're looking at
It'd be a tough pill to swallow, but you'd only be swallowing it once as opposed to having to sell it every single year.
Right.
And secondly, Mr. Chairman, my question to Gary is, what is the rate of return in 2021? Now, the S&P was 26.9, and the Dow was 18.7, and I presume we have a balanced type of portfolio, but you also have some equity, the private equity money in there too, as I assume, from the PRIM fund. What was the rate of return?
The PRIM fund was probably on the calendar year about over 24%, 23, 24%.
Great. Thank you, Mr. Chairman.
There was one comment I wanted to ask about, though, is that if we were to take, you know, the 20 million or whatever and put it into the Opeb fund, right, from a bond source, while we still have the principal, if something were to go wrong, that money is dedicated for healthcare, right? That's the one, we couldn't repay part of the bond back from that fund, is my understanding.
Correct.
Right.
Correct. What you could do is, and not suggesting you would be the first choice, but, you know, instead you could only use the trust fund for OPEB benefits, But look at column 4, that you're paying out of cash. You could, you know,
Sure, yeah. You
use
could
it
s-
that way.
Right.
For a couple of years to give you
Well,
some.
case
look at
we
the
ran into trouble,
contribution.
yeah.
If you're paying 3% for money, right, for the $20 million, look at what your contribution annually is, which is substantially lower than, substantially higher than that.
Right. You're the last one.
Thank you, Mr. Chair.
You should have gone earlier.
I queued up a few of them along the way. Just regarding what Phil said, I get what you're saying. I think it's a pretty slippery slope when we start borrowing money to invest it and, you know, work the float on that. I can see a million ways that backfires. I think it's trying to be a little too clever, even though I understand the numbers.
It doesn't for insurance companies.
Yes, if nothing else, it certainly lowers your available borrowing capacity, if nothing else. I'm curious with the retirees. I see they pay a certain fraction of the health benefits. How and when is that fraction determined, and do we have any flexibility once someone retires to change that fraction, or is that fixed at some point? Or
It
how's
has,
that work?
it was grandfathered. At one point, it was at a 10%. There's some retirees at 15%, some are at 20. I think the current rate right now is at 30%, so. So we've moved that along the years.
So when someone retires, is the percentage then frozen for their entire retirement
Yes.
at that number?
Yes,
Okay, so when we're negotiating with current employees, we're also negotiating what retirees will start at and stay at forever.
correct.
So we don't have any flexibility once someone retires to alter that number in any way.
Correct.
Okay, that's good to know.
What has happened is that when we were doing the budget for the insurance and the 32B costs, I noticed the contributions to retirees were slowly creeping up from that. We have more 20, 25, 20,
It's just that we're getting,
right, as it moved on,
Changing that
yes.
number.
So that's moving up a little more, but.
okay. A number I'll throw out there, and thanks to Gary for supplying data on this, is the internal rate of return that we're actually seeing is 10.5% right now from August 2013 through November of 21. So for a relatively conservative investment, you know, that's over the entire period. That's not a bad number in my mind. One of the things, so just in terms of benefits that are included in Opeb, there's the health insurance, and then we're also paying 50% of an optional life insurance, it looks like. Is there any other benefit, or is that the whole bucket of things that we're on the hook for there?
I think that's it. There's no, yeah.
Dental, but it's retiree pay.
Yeah, so there is a dental benefit, but it's 100% retiree. But
We're
that's
not on the hook for that,
part of,
right?
yeah, exactly. That wouldn't be part of this obligation.
Okay, good. And then pensions are for teachers by the teacher's retirement, and for non-school is the Middlesex County retirement. So that's a separate bucket to be dealing with there, and those are presumably, are those fully funded?
No, the Middlesex County retirement system probably almost, I'm not sure if every retirement system out there is in the same situation as the municipalities.
So we'll be paying into those some catch-up money at some point, no doubt.
So we are paying an annual payment.
We're already doing that.
We are already doing that, and when we look at some of these numbers, and we've had this discussion at some point, when the Middlesex County retirement system is fully funded, it would decrease, possibly reduce what we would have to pay in total for the unfunded liability.
Is the teacher's retirement fully funded, or?
No, no.
Not, okay, so everyone's doing the same thing right now.
Everybody, yes.
What is the teacher's retirement invested in? Is it still the
Prim.
prim? Okay.
Okay. Just one detail that you mentioned on page 27, it talks about the percentage of active employees that elect coverage, and that number was increased from 100 to 115%. So I was just curious how that could be over 100.
Because the active employees in the valuation are the ones who currently have coverage, it's not all employees. So and one of the reasons we changed it is because as we looked at the data that we received, we saw that there were retirees in this valuation that weren't in the prior valuation, indicating that people may not take coverage as an active employee, but take it when they become a retiree. So they might have a spouse with coverage.
I see,
They might be
okay.
on a spouse's plan as an active employee,
Okay,
because it
so
might be
that-
cheaper, but then the spouse doesn't have retiree health, so then they come back on this plan.
So we actually are seeing over 100%
Well,
participation?
Yeah, because we're anticipating that some of the people who don't have coverage now have elected not to take coverage, not because they're not eligible, but have elected not to take coverage will come on as
Right,
retirees.
but you're basing that assumption on the fact that we're seeing that? is
Yes,
basically-
yes.
okay.
Yeah,
Yeah.
we'll monitor that, with each valuation, we
Yeah.
monitor that
Yeah.
number, and if it needs to change, certainly.
Yeah.
Okay. So I just, and this maybe doesn't matter a whole lot, but I'm just curious on the lowering of the discount rate. Is that just people have decided to be more conservative over the last few years because the investment returns haven't been tanked all of a sudden? So
Yeah.
what's driving that?
So it's not, no, it's not arbitrary. So we have to look at various metrics and be able to support or justify the assumption that we're using. And the way we do that is we look at the asset allocation of the trust, which is the PRIT asset allocation, and we look at capital market assumptions for each asset class. And we look at a couple of different sources. So we have an investment advisory group, Siegel Marco, that prepares their own capital market assumptions. And we apply those capital market assumptions to the asset allocation to come up with an expectation for the portfolio. So it's a forward-looking expectation of what the portfolio is going to return in the long term based on forward-looking assumptions. And that's the real key, is the forward-looking assumptions.
Sure.
It's also key that it's an assumption. And then, but we also look at a couple of different benchmarks as other sources of those capital market assumptions. And the PRIT consultant also does an expectation of the portfolio. And between the two, we come up with, a reasonable assumption. One way to think of it is, there isn't one right assumption, there isn't one right answer about what the portfolio is expected to return. There's a range of reasonable assumptions, and we, pick a number within that range. The trend of those capital market assumptions since 2008 has been down, 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 and which is why you see this downward trend both in the assumption, in the prior valuation and the current valuation. If you look online at the state teachers report or the state employees valuation report, you'll see the assumptions there are being lowered, and any of the studies on national retirement plans show a downward trend in the assumption, because everybody's looking at the same downward trend in the expectations.
Okay, so no irrational exuberance here.
No, it was really interesting, and PERAC, which is the Public Employee Retirement Administration, had a meeting at Middlesex County in December, and they showed one of their charts that talked about the different plans in Massachusetts. And in 2003, about 52% of those plans had an 8% return, and none were under 7.5. You bring that through to October of 21, 82% of the plans are under 7.5% for a discount rate, and 22 are between 7.5 and 7.9. No one's at 8%. It's been continuously being lowered, and it's conservative approach, but I think it's a more fiscally steward type approach also.
No,
So
it's a safe assumption. It doesn't affect what we're doing now anyway,
Right.
realistically. So
Right.
I think that's fine.
It's interesting, if S&P were to look at this, they would probably say a 7 might be an aggressive assumption. Granted, they have a different
Right.
perspective of
Right.
what's reasonable, and they often quote, 6 to 6.5 as being, a reasonable long-term assumption for a well-diversified portfolio, such as the
Right.
PRIT portfolio. So don't be surprised if you ever see that in a rating from one of the rating agencies.
I remember
Comment
one
on
of
the
my
assumptions.
comments, and it might have been from, I don't remember the fellow's name from PERAC. I said, I wrote here, recommend 6.75 to 7, so it continues to, might have been you too, Kathy. I'm not sure.
The last one is more of an opinion question, I guess. You've mentioned that there's several of these pension funds that are not fully funded, and a lot of towns aren't trying at all. And I'm just wondering if strategically, if, I'm looking, 2048, we're sitting here apparently with $250 million in our fund, and we're fully funded, and there's a bunch of towns that aren't fully funded. Are we going to end up funding those towns, is my concern, ultimately through the state bailing them out in some way? Or, have you seen any indication that things could head that way, or is the state going to start turning screws so that everyone is putting money in the pot? Do you have any opinion on that?
Yeah, I
Wait a
mean,
minute.
I guess I would, yeah, who knows? Who knows in 2048? But,
I just know that
I think if
you always
you-
go for the rich people when you're looking for money, right?
It's
So
already
the-
happened. Look at Delphi and look at a couple of the Michigan
Yeah.
municipalities.
well, the money's in
That's-
trust, so your money can't go to pay other people's benefits. But you did ask a slightly different question. Could somebody get a bailout and you don't get a bailout because you're fully funded?
Exactly.
I suppose anything's
It's effectively coming from us.
anything's possible, but you look at the retirement obligations, and there haven't been a bailout on the retirement obligations, and there is an obligation to fund those by 2040. So I would tend to think not, but whether there's more regulation on the types of benefits and the generosity of those benefits. So you pay for 75% of the premiums now. 70% of the premiums now. Maybe there would be a mandate that towns can only pay for 50, and that the retirees has to pay for 50. Maybe that would be that would more likely be an alternative to a bailout, at least initially. I would think that there'd be other solutions such as that.
Okay, thanks.
70-30, I can't say that's the norm in the state. I know there are still some communities that are paying 90%, 85%. Town of Burlington, we made that change a good over 10, 15 years ago to go to 70-30. So it also helps the fact that we're about 10.5% funded. It helps us with the bond rating. So it's everything, the balance sheet for Burlington is very strong, continues to be strong, and this helps, so.
Thank you, Mr. Chair.
Frank, thank you for your patience. You have your hand up.
That may be a leftover.
I don't think so. Is it a leftover, Frank?
Mr. Chairman, can you hear me?
Yeah.
Okay, I want to make two comments to follow up two things. On the discount rate, when we set this program up in the very beginning, we picked an earnings number that we thought was reasonable, and we did that along with help from consultants and whatnot, so that we could put a plan together that seemed like it would be achievable, that we wouldn't be over-investing, we wouldn't be under-investing. We didn't want a program that came nowhere close after 2 or 3 years of what we said it would do. But I can honestly say at the time, I was uncomfortable with the earnings number we picked. I believe we either started at 7.5 or 7 3/4. I don't remember. But this discount rate it's really for planning purposes, and you want your planning to reflect on the conservative side, but close to what the market will do relative to the funds that you're willing to invest in. And so, the balance fund that we're in, it is a good one. And you got to remember, you're fiddling with taxpayer money here. So it's not like you can go out and go buy some high performance equities and look for, 2x returns. You can't. You have to have a balance fund, and you've got to be responsible. So I think the 7% number that we're at is a good planning number. If we lowered it, all it will do is either stretch out the time it would take to get to neutral, or it would pressure you somewhat into putting more money in each year. I would follow the way Siegel Associates is doing it there. They're picking a number that reflects what they think is the best guess at our situation. Clearly, you could do better in the market, but the risks go up. And I don't think we want to go there no matter what, because it's taxpayer money. That's my view on it, at least. One other thing I wanted to mention, relative to benefits and retirement funds and all of that, the employee pension fund, in my mind, really can't be compared to the healthcare benefit, because the employees' wages are garnished at something like 11% to pay their pension. And the idea of the pension funds for the teachers and the municipal Middlesex County Retirement Fund is that it's self-funding through garnished wages. Now, it fell way short of that. I don't know, back maybe 20 years ago, we started to get, see some real problems. And so the towns were then tithed to make up the difference. And that's why it became an unfunded liability that the towns began to pick up, because we just simply didn't get enough money out of the employees' annual wages to cover the size of the pension that we were guaranteeing. So the pension fund, it's funded in a different way. And theoretically, by getting the garnish right and the benefit right, that comes a lot closer to self-enduring without an enormous, $250 million asset sitting out there to finance it. Health insurance is different. There's no garnishing going on. It's just a 70-30 split of it. And that 70% that we pick up going forward till they get on Medicare is a liability that we have to fund. And that's why I look at this a little differently. And at some point, if the Middlesex retirement tithing actually catches up, and that trust fund gets there's enough money in there that we don't need to be tithed every year, then we could conceivably shift some money from the pension funding that we do annually into OPEB to speed that up. That could be a source of some funding in 15 years, potentially. And if I said something wrong, Kathy or Gary, correct me, but I think that's a correct view.
Yes, yes, it is correct.
Thank you. I don't see any further questions, so thank you very much for coming out. We appreciate it.
Thank you.
Thank you.
Nice to see you all again.
Good to see you.
Yeah, likewise. See you in a couple of years.
Happy New Year.
You don't have anything else for me?
If you want to help us review the new employee position worksheet, you're more than welcome to stay, but you're not required.
No. We actually looked at that with Mike and David and Frank at a subcommittee meeting earlier this week. I think it's a great program.
Awesome. Okay, thank you. Mike, do you want to go over the new employee position worksheet?
I'm sorry, Steve, you were cutting out in the audio.
Oh, I'm sorry. Would you, the floor is yours.
Oh, okay. Yes. So Steve had sent out an attachment. Maybe I'll just share it here. Let's see.
I can share it if you have trouble.
Yeah, why don't you share it? I'll stop sharing.
Mike, maybe you can outline the motivation for it while it gets up on the screen.
Okay. So I think we talked about this a little bit back in the spring. The motivation for this form is interesting. To give us consistent information that will help us when departments come forward with a request for a new hire. Right now, as it stands, we don't really have any information that we ask, people to provide when they're looking to hire somebody into the town. And, so they'll put together whatever information they have or they think they need. Sometimes it's a good amount of information. Sometimes it's not a good amount of information. But the idea is that, the decision on adding people to the town to hiring obviously has long-term ramifications, as we just saw, on, costs currently and into the future. So it would be good if we could let people know what information we need to help us make a decision on this new position request. So I got together with John Eiler and Frank Monaco, and we kind of talked about this early in the summer, and then started meeting with some folks from the town, John Denizio and Joanne Faust, and brought up this idea with them, and they were very supportive of it. We had met and talked about the types of information we'd like to see to make it a data-driven process. That's kind of what Ways and Means likes to see is data and numbers. That's part of our job. And we talked about it a little bit, and then Joanne also went out to her contacts in different towns and looked around to see if other people had pulled anything together, some type of form like this. And I don't think anybody really had an exact form, but she got some ideas and then used, information that she is familiar with from, being HR person and hiring folks, and put together this form, which, let me see if I can make mine big enough to see here. There we go. Okay. It's not usually so black and, I think the colors got reversed here, but
Dark mode, I can switch it if you need me to.
yeah, either way, I mean, it was fine.
Steve, can you lose the toolbars?
Oh, there we go.
How's that?
Okay, perfect. So basically, it's a 2-pager. The first page goes through, some information that we'd like to see, and encourages, in some cases, feel free to attach more data, into this 1-page form. The second page is if there has not been a job description provided for the position. And I think in most cases, there should be a job description, but I guess it's not uncommon that there isn't. So the second page would be filled out by the requesting department if they did not have a job description available to attach, so to speak. So let's see, can we go back up to the top of the form? Yes, good, okay. So, basically, we're presenting this to gather feedback and see if this is something we want to utilize or perhaps change a little bit. And I think as time goes on and we go through a couple of iterations using this, we may naturally decide, okay, we need some other information, some pieces we don't seem to need, and we'll adapt it as we go. But as you can see, we're gathering basic information: the department, the title, proposed start date, the grade, the union, and so forth. The reason for the hire, whether it's a new position or a replacement, employment category, full-time, part-time, temporary, projected salary listed there. And I think even if we stopped right here, which is not very far down, we're probably gathering a lot more information than we have in the past. So this is just stuff we haven't asked for, and many times we haven't received. Then we also want to capture annual current expenses. So there have been instances where a new position was approved, and then later on we found out that, oh, that position actually comes with a new vehicle as well. So that was an unknown at the time. So we want to capture that type of information if there's a vehicle required, training, stipends, etc., as well as future expenses listed in the next box. And then if we go down to the next part that says justification for position, I think there's some really key requests here that help us to understand why this position is needed. And this is where we would ask for provide numerical and statistical data. So, it's really just check boxes, but behind those check boxes should be attachments of more information. So, has there been an increase in workload over time? I think that's sort of happens. That was, for example, the new position in the Board of Health, I think, may have fallen into that category. Are there additional services that need to be provided? That one maybe, let's see, the position we created to as a kind of a development manager to kind of bring business to the town, maybe that would fall in there. We'd also request salary and staffing comparisons to other communities. I think when the Board of Health requested a position, Paul Sagarino did a great job of going out and just pulling in information to compare to other towns. It was impressive the amount of data that he pulled together that I think was helpful and useful. So that's again helps justify the position. And then finally the job description, where if that's not available, then complete page 2. So then we ask for increased revenues or grants that will support the new position. I guess some sign-off approvals, and then a box where we can indicate the actions taken by Ways and Means. I think that's all of the first page. And then the second page, again, is if there is no job description, then fill this out as a job description. So we'll have a general purpose of the position, who it reports to on the title, education requirements, other experience needed, types of skills, etc. So I think all this information, would be very helpful for us to understand the type of position and how it's going to be filled. You want to scroll up a little bit, Steve? I think that covers most of it. Yeah, so again, some other things on supervisory responsibilities and functions that the position will do. And again, these are things that many times we don't get at all. We don't get any of this information, or we get it kind of in a general verbal description, and it's sort of hard to remember or to kind of absorb. So the purpose here is really to provide us more information and kind of standardize the information that we receive. So that's, I guess, the overview of this. And Steve, did you want to open it up for questions or discussions?
Yes, I'd first like to thank the subcommittee who worked on it and Mike, the effort to get this done. Looks great. It will provide us with a lot more additional information that we haven't had in the past, and will help us to make better decisions, and to Frank and John for working with Mike to get it done. So now I will open it up to questions.
Yeah, most of the credit goes to Joanne on the performance, so she did a great job.
Oh, that's a good point. Also to the town folks who helped. Gary, Joanne.
It's good too, because working together on it, there's joint buy-in to use it. So that was good.
Mr. Chairman, can we move to adopt the recommendation of the subcommittee?
Yeah, seeing no questions, I'll take that motion. Is there a second?
Second, Mr. Chairman.
Thank you. Oh, David has a question before we vote.
Just one very quick question. So normally we're seeing new positions through the annual budget process. So again, I guess it relates just to the one box and the Ways and Means. Are we going to be voting specifically on new positions outside of the normal budget process, where it says Ways and Means action taken, or I guess what is going to go in that box, and how this is going to be good supplemental information as part of the budget process, or is the budget process changing?
So I'll answer the question about filling that form out, but I don't think anything changes with respect to the budget process. I think most of those positions would still be allocated at that time, but during the budget season, when we're normally looking at new FTE positions or new positions in general, that's when it would get evaluated and probably filled out. But Mike, do you want to add?
Yeah, so good question, David, good catch. So yeah, I guess it will be part of the budget, not as a separate vote. But, you know, I think that the process that we go through in considering new position requests, that may be something that we want to consider. Just think about if we do want any changes for that. I guess the one thing I would like to see is giving us kind of, notice that new positions are being requested as early as possible. So it's not sort of a last minute thing that kind of comes in with a budget. And, we're looking at this for the first time, when we're trying to vote on the budget. So I don't know how we would do that. It's probably something to consider, but I'd like to see kind of some advance notice on any new positions, and so that we can, review this information without it being kind of, last minute.
Follow up, David, or are you good?
Roger?
Yeah, so I guess a couple of questions about the scope and when the form gets used. The checkbox for replacement begs the question, it's like, well, do you really need this form if they're replacing an existing, somebody leaves and they have to replace it in the same role, salary, conditions, and everything? I would not expect to need a new form in that case because the budget impact, the scope, the scale, et cetera, doesn't change. Now, maybe if you're essentially shifting responsibilities, then it would be appropriate to fill out the form, or if the salary was changing or some of the other dependencies. I think that makes sense. Given the way that this came into existence, and I'm probably going to stab myself in the eye here, but it doesn't seem like it seems like it applies to municipal positions and not the schools. What was your assumption in constructing this in that context?
Yes, so we talked about this being something that the town side would use, where the school has its own kind of budget process and different ways of it's basically a bottom line number we vote on. We didn't think that we would ask the schools to use this form. However, there must be some type of process that they go through, and maybe this might help them formalize their own process. I'm not sure, or do something similar. But our intention was that this was for the town side, not schools.
Okay. I'm sure Joanne would, be able to apply it since she's I guess it's about half time with the schools. But it's one of the cases that came up last year was the director of diversity, inclusion, et cetera, that got a lot of attention in order to specifically craft the job description, et cetera. So they might be able to use it. And so it's good to know there.
Yeah.
I guess my other question was sort of about the box at the bottom that says Ways and Means Action. We are an advisory body, right? So I guess we can approve or disapprove. I guess that's kind of what's expected to be in that box, right?
Yeah, exactly. So I guess we'll test it out, as we go through and see what makes sense. Ways and Means Action taken again, this is typically part of a budget, so maybe it's, approved as part of, Department X budget. Yeah,
Yeah.
it's a good point. I'm not sure we'd have a lot to put in there.
Yeah, I think it's a good starting point. I would maybe not even a starting point. It's a really good form, and I think it's nice to hear that there's some flexibility in how it evolves. So,
Yep.
Thank you, Mr. Chairman and Mike.
We can certainly iterate a bit.
For sure. John?
Thank you, Mr. Chair. Yeah, kudos to Mike for spearheading this, by the way. From my point of view, I think the intent was essentially to mirror what we have for our capital request form, just have a little more formalization behind the data that we're getting ahead of time. As far as the schools go, and Roger, you saw this one coming, it would probably, I think it would be beneficial to suggest to the school committee and administration that they do have a little more formal process to it, or visibility into the process, perhaps I should say. I think each year we see the list of potential new employees, and then what it was pared down to in the final budget. And I think there's some assumptions that everyone knows what a science teacher is, so maybe they don't need to have this level of detail, but I think it would still be beneficial to have something a little more formalized than perhaps what we're seeing now. And the director of diversity obviously fell outside the process because that was something that the governing board didn't even ask for. But certainly if we could have gotten the town meeting members to fill it out, it would have been great. Thank you, Mr. Chair.
Seeing no further questions, the chair will put this to a vote. And I will have to do a roll call. Okay. Brad Bonds.
Yes.
Christopher Campbell. David Tate.
Yes.
Edward Parsons.
Yes.
Frank Monaco.
Yes.
Jaya.
Yes.
Michael.
Yes.
Rob.
Yes.
Roger.
Yes.
Tanya.
Yes.
Phil.
Yes.
John.
Yes.
And the chair votes aye. It's unanimous.
Doug Davison?
Oh, did I miss Doug? I don't see Doug today. He's not there.
Oh, he was here earlier. Okay.
Yep. So the motion passes unanimously. Thank you, Mike, again, and the subcommittee for all the hard work. And it looks really good. So with that, I will have meeting minutes for the next meeting from September and also from this meeting. From a schedule perspective, the town is preparing to kick off the budget season with the annual budget guideline meeting, which will be coming up in the next week or so. Following that, the committees will be meeting on 119 to go over the budget guidelines if they're set by that time, and also the January warrant articles. I did forward the backup material from the Selectman's office, which I didn't have earlier, and I'll send out a final assignment of the committees now that we have 2 new members, and also just make sure the table is updated for the warrant articles and which committees are covering which. And I think that's it for now.
Are we expecting to meet next week? Or?
We'll be meeting 119.
Okay.
The town meeting is 124. Not seeing any further actions or items on the agenda, the committee will certainly entertain a motion to adjourn.
Motion to adjourn.
Thank you. Is there a second?
Second.
All those in favor?
Aye.
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 Have a good night, everyone.
Good night, everybody.